Yet again, I'm here, your host, in today's video presentation. Rondo Franklin is my name, the lead tutor, Chief Executive Officer, the pioneer of FCL Accountants Tuition Center. In today's video, I'm going to focus on financial instruments. I'll explain the treatment of financial instruments in two situations, where there is just a debt and where we have the convertible loan stock. I'll also explain how to split the convertible loan stock into the debt component and the equity component. Before I get started, I just want to encourage our viewers to ask questions specific to today's question in the chat box. All the questions raised will be attended to depending on the availability of time. I also want to encourage our viewers to make comments about this video in the comment section. The comments will be taken very, very seriously and will be used to improve our lecture delivery. Today's lecture, or rather video presentation, is applicable to students studying CA 2.1 under Zika and those studying financial reporting under ACCA. So now we have a question here. The first part of the question is explain circumstances which a financial asset would be classified as an amortized cost instrument. So I want you to pay particular attention. A debt portfolio in the books of the holder is classified as financial asset. Financial assets can be measured at amortized cost when the following conditions are satisfied, or rather, when the following tests are passed. So we have number one condition. We have number one condition here. Business model tests. The business model test. The business model test. So business model test states that when an entity holds its debt portfolio to maturity, then the business model test is passed. So the debt portfolio are not meant for sale. They are held until they mature. Then they should be measured at amortized cost. The second test is contractual cash flow test. Contractual cash flow test. Contractual cash flow test. This simply means the entity is holding the debt portfolio for the purpose of collecting the coupon interest and the principal at specific dates. Then, if the two conditions, or rather tests, are satisfied, then the financial asset should be measured at amortized cost. Then we now move to another question, question B. Mukela Limited utilized a number of financial instruments in the year to 31st March 2022. The following are the details of the instruments. On 1 April 2021, Mukela issued 5% 1 kwacha loan notes at a discount of 2% and incurred issue cost of 0.6 million, the loan notes have an effective interest rate of 8%. So the question there, show the effect of the 5% loan notes on the financial instruments of Mukela. So this here, we are going to work it out. First, we find out what is the value, the fair value. The fair value is, we can use 24,000, we can use 1,000, 24,000 million multiplied by the fair value per one, which is 1 kwacha, which will also give us 24 million kwacha, but we are using the thousands, we have removed the zeros. So now I want you to understand the loans issued at a discount simply means we remove the discount. The issue cost incurred on the issue of a loan will also reduce the loan. So this one will be fair value of the loan, 24,000, less the discount of 2%, you remain with 98. So these are in thousands. So there we have 23,520. Less issue costs. The issue cost here, we have 0.6 is equal to 600 because we are dealing with thousands. We have 22,920. And here now we have effective interest. The effective interest is 8%. 8% of 22,920. That gives us, we have 1834. Coupon interest is always on the original fair value of the loan. So this will be 5%. 5% of 24, it will be 1,200. So the total, which will be the non-current liability, will be 23,554. Now, the treatment here will be, we have the statement of financial position, non-current liabilities will be 23,554. Statement of profit and loss, finance costs. The finance cost here will be the effective interest, which will be 1834. So that's how we treat this financial instrument. Now we move to another type of financial instrument. This one is convertible loan. So we go to, on 1 April 2021, Mukela Limited issued 15 million, 3% 1 kwacha convertible loan stock at par. The loan notes can be converted at the rate of 1 to 0.5 equity shares per note at any time before 31st March 2022. However, any loan notes not converted are redeemable at par on 31st March 2024. The loan notes pay periodic interest on 31st March over their term to maturity. Similar loan notes without conversion rights are the market interest rate of 8%. That should be the effective interest. Now, let's answer this question together. I'm going to explain how you split the convertible loan note into the equity and debt component. The equity component is the residue, or rather a balancing figure. Now, according to IS 32, the debt component of the debt component of the convertible loan note is the present value, is the sum of present value of interest payable and the principal payable. Using the effective interest. Using the effective interest as the discount rate. As discount rate. This is very, very important. So we need to determine what will be first the fair value. The fair value of the convertible loan note will be 15 million. We can use thousands. Multiply by 1 quarter. It will give us 15 million in thousands. Then coupon interest, which we are going to discount, coupon interest will be 15 million multiplied by the coupon rate interest there is 3%, which gives us 450. So the debt component is calculated as follows. We have the year, cash flows, discount factor at 8%, which is effective interest rate, present value. Year 1, we have 450. Year 2, it will also be 450. Year 3, the final year, there will be 2 components, coupon interest and the principal amount. So it will be 15,450. The discount rate we are given, 0.926. This will give us, when you multiply, to be 417.70. And then in year 2, we have 0.857. This will be 385.65. And in the final year, we are given also 0.794. Multiply by that, it will give us 12,266 to 67.30. So the sum here will be the debt component. The debt component there will be 13,069.65. Equity component is the residue or balancing figure, equity option. The balancing figure there will be the difference between the initial loan and the debt. This will give us 19,333.35. That will be the equity option. Is that okay now? So now we need to measure the debt component at amortized cost. Amortized cost. We have debt component 13,069.65 plus effective interest, which is 8%. 8% on the debt, 1045.57. Coupon interest does not change. It will be the same because it is based on the original loan, 5%. It will still be the same, which is 450. This has been paid, you remove it. So we have 13,665.22. So now this will be the non-current liability. So in the statement of financial position, the non-current liability will be this. In the statement of profit and loss, the finance cost will be that. So those are the figures that will go to the statement, the financial statements. In the statement of financial position, we have 13,665.22 kwacha, the non-current liability. In the statement of profit and loss, we have 1045.57 as the finance cost. So that is how you deal with this question. For today, we can end here. Just as a reminder for the new subscribers, please ensure that you hit the notification button so that you are able to receive notifications when the videos are available. Also, do not forget to like and share the videos. For those who've been there for us, both the new subscribers and the old ones, on behalf of FCO Accountants Tuition Center, I just want to say thank you and God bless you beyond measure.